Hello, welcome back. One of our subscribers has suggested to take a look at a company which is called StoneCo Limited, and it's a Nasdaq company. And so I definitely wanted to take a look because I really enjoy taking a look at your suggestions, guys. So please keep them coming. This one seems to be a Brazilian company. You can see it here on BR. And this, by the way, is the new company profile page. It's part of our company analysis here. It's going to be a lot more. It's going to have earnings transcripts. It's going to have information about sales within insiders of the company. So over here it has the key executives right now. And it's a work in progress. But this page is probably almost complete. So I kind of wanted to use it in this analysis. This is very useful because you can see a quick description of the page as well, of the company as well, which is financial technology solutions to merchants and integrated partners for e-commerce in stores online and mobile channels. And that's a Brazilian company. It's worth noting that it was founded in 2020 and it's operating in Cayman Islands. So they probably have some advantages in terms of taxes, I'm assuming. So the IPO was at 2018. And I have a couple of interesting information about the company in case you want to call them. But you can find some things about the CEO, for instance, or the volume average, which can be useful in case you are trading the company. This is a company that has quite some volume here daily. And so this is definitely worth trading. And another thing is the beta. In case we don't know what that is, it tells you how volatile a stock is. And typically the stock market, like the S&P, is 1.0. And anything above that means the company is more volatile. So the higher it is than 1, the more volatile it is. So this is about a fairly volatile company here in terms of its stock movements, stock price movements. So you could expect it to go up and down a lot, at least till it stabilizes potentially. Now, after we took a look at this, let's actually examine what is going on with the stock analysis part of our tool here, which has a few new things here. You can see charts for different periods of time, which I think is very useful here. So currently the default is 1 month, and you will see that the company has been from 13 down to 8, and you can understand that it is very volatile, of course. This is one of the reasons why the beta was that high. But if we take a look at the 5 years ago, you will see that the company back in its IPO days was at about $31, and now it's it has gone lower and then higher and then back much lower again. So from like December 17th to 2020 to December 1, 2021, it has gone from 81 to 15. So it has lost like 80% of its value. Insane amount. And so this has really gone down quite quickly here. And we can always take a look at 1 month again, 3 months. You will see a different picture, but kind of tells you the same story here. A company has been going down and it's going a little bit better in the last maybe weeks or so, a few weeks. Now let's take a look at the financials. You will see the P/E ratio here being negative. It used to be positive, high but positive, meaning that the company was making money, but now it's losing money. That's not a pretty picture to see, of course. But the price to free cash flow is low and positive. Yet again, it used to be quite negative. So this may change, may be at similar levels here. The outstanding shares, this is a very interesting thing. They kept on increasing shares till 2021 December, taking advantage of the stock price, which, as we know, if we take a look at the 1 year here, you will see that it was at these levels over here when they were actually selling. But now they started buying again because you see this gets decreased. So they're actually buying back shares, a lot of shares here. And so they think potentially that the company stock price is very low. And this is why they want to be buying back. That's the board. Now, are they doing well? I mean, they definitely know more than us, but we can actually examine a few things based on the financials that we're seeing. Now, the 5-year revenue growth has been increasing, which is nice, yet the net income growth has been going down. This is something that I don't like to see. These values have to be positive. It's very vital. Now, you can have maybe some year that is negative, although this is a massive increase. But overall, this has been going down because remember, it was minus 32 here, so it wasn't positive to begin with. So the decrease has been pretty insane here in terms of net income. So the company doesn't look like it's funding operations from profit. Yet the free cash flow is up. And so we will examine why and how. Now, you see this 200% increase, and it is 200%, but it used to be negative. negative minus 430. And so it is indeed 200%, but it just went into positive territory, as you can see. So the price to sales ratio is very good. The gross profit margin is fairly good, very good. But the net income margin is bad. So we're probably looking at a company that's making money from operations, from selling stuff actually, but not from operations, not from actual profit if you deduce all the expenses. That seems to be the story here. Negative return on equity and assets as well. Okay, and a great price to book ratio, by the way, this is very low. It means that the company is basically selling on assets, on book value. So that's actually pretty good. It may be relatively undervalued in terms of its assets, that is, not its free cash flow. So the next thing, I'm going to take a look, at the income statement here. I just want to understand why they are losing income here. So their net income has been increasing, and that's the good thing. Yet the past year has been negative, and so that's the only bad the only bad thing about their their net income here. It has been going down, and actually from positive it turned negative, so that's not great to see. And I'm assuming this has to do with, let me take a look here. Yeah, the total operating costs and expenses went up. It doubled here, so much more total operating expenses here. Maybe they have spent quite some for, yeah, you can kind of see here selling and marketing is a big expense here, and general and admin expenses. A lot of extra expenses here, and the company is not making that much money that they can afford that many expenses. Although it could be part of a decision, really, actually having this kind of expenses. Yet their net income is negative in the last year. Now the balance sheet of the company is picturing, actually, you will see here, the total liabilities of the company are 5 billion, and the total assets are 7.5 billion. Which is a good thing to see, because the company is total equity positive pretty much. So they have a total equity that is not negative, of course, so they do have some assets. And the cash flow statement is the important thing that will tell us what's going on with the operating income here. And you will see that it used to be negative, but actually now it's positive. You will see also that there is quite some extras in terms of stock-based compensation and depreciation and amortization here, which is almost 100 million, and some other non-cash items that could be one-time deals, really. These tend to be one-time things for the most part, so I would probably not take this into consideration and actually deduct it from my free cash flow projections for the future, I would say. I think that this is probably a one-time item, and we could always examine the details, but I don't think this is going to be sustainable. So again, it's another non-cash item. So it is actually added back to the cash flow statement, because the cash flow statement is about cash, and so any non-cash expense like stock-based compensation is added back. And this is why it pays to also see the net income and compare it to the free cash flow statement, to the free cash flow, which is what we're doing here. We want to make sure that our free cash flow comes from profit and not this kind of expenses added back as a free cash flow. So you will see here that the common stock repurchase has been increasing massively, and you see this as a negative number because they spent money to actually buy common stock. As you saw, they are buying back shares, a lot of those, and this is why this number here. This is generally speaking a good thing for investors, of course, yet we're not just going to buy a company just because it is buying back its own shares, of course. So the free cash flow of the company is positive here, but practically speaking it should be negative. Again, this kind of logistical trick where you can actually add back a non-cash item to a cash flow statement and make it look positive doesn't play out well here, and you can actually understand it from the net income of the company. And if we use our stock evaluation tool, which is another very quick way to understand what's going on, you will see that the revenue of the company is positive, but the net income over here has turned negative over here. And the net income margins, again, are in negative territory in the last year. So, if we were at this year, things would be better, really. But this one is not looking that great. Now, I don't know whether this has to do with the pandemic or anything of that sort, although this is an e-commerce company. But it's not a picture that I like seeing here. Okay. The revenue growth of the company here has been pretty good, and that's the good thing about it. And The net income margins again have been negative in the last year. Typically they tend to be around maybe 20 to 25, I'm assuming. It looks like here. And look at the free cash flow margin. This is terrible here. It's pretty much always negative. And apart from 2017, I'm seeing here. But yeah, this is not really great because the company is not. It does not seem to be converting net income to free cash flow really here, based on what we have seen. So, can we really use this model here? We can try, although it's gonna be problematic because this kind of discounted cash flow models work for companies that are profitable for the most part, or we'll have to make assumptions. So we can assume maybe let's just say 17, 20 and 23 in terms of revenue growth, because the company seems to be achieving quite some good revenue growth. The net income margin that I'm gonna go with will have to be in positive territory, of course, and I'm gonna take it to let's just say 10, 12 and 14 here, which is going to be conservative because we have negative years, and especially last year. The free cash flow margin now, this is a big mess. And what can I even use here? This is negative for the most part. I can't use negative because if I use negative, we're going to be super low or even negative, really. And so I will go, let's just say that the company will normalize. This should be much higher, typically. And let's just go that the company goes 30, 35 and 40 at some point. And an annual return of 13 is what I want to be making at least. And so, yeah, you will see that this company is overvalued for what it is right now, for the cash that it is making. And, you can say that, of course, the company will potentially grow in the future and become a big thing. But right now, I just don't see that it is worth that much, just because it doesn't seem to be translating their success, I'm assuming, into profit. And I just don't see free cash flow coming in, and I don't see net income coming in at least sustainable one. And so I would probably stay out of the company. Now it can be a great company to trade, of course, because it's down a lot, so it can be a good ticker symbol to trade. But for a long-term hold, it's gonna be a little bit dangerous and frankly a little bit speculative. It could work, who knows, but right now I probably would avoid it, to tell you the truth. And I know that you may like it, and thank you for suggesting it, but I have to be completely honest here with what I see. And again, of course, it's your own decision, guys, whether you want to buy or not. I'm just giving you my honest opinion here based on what I'm seeing and what I would do personally. And what I would do with this one is definitely look to trade, and maybe trade it for a sort of like a lottery ticket. But in terms of holding for a long time, that would be a little bit suspicious. So hopefully you enjoyed the video, kind of gave you some ideas. And again, thanks for the recommendation. Thanks a lot. And thank you guys for watching. Please leave a like if you reached that far, and subscribe to the channel because there's gonna be a lot coming out. I'm working on this tool restlessly, and I'm gonna be giving you access sometime soon, actually, if you're around, so you may want to subscribe. So thank you for watching the video, and I'll see you soon. Bye-bye.